So I want us to look at what liquidity are. I know we've been hearing of liquidity, 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 liquidity. What does it really mean when it comes to trading? Now, the word liquidity simply means money. That is just the bitter truth. The word liquidity simply means money. And markets move where there is money. It is actually money that moves the market. And that is why we are here to make money, because there are a lot of money in the market. So when it comes to the chart, there are so many things that is considered as liquidity. So we are looking at liquidity as a topic. So there are so many things that people consider as liquidity when they look at their charts. You say we have what we call trendline liquidity. We have what we call trendline liquidity. We have M pattern and W pattern, or what you guys call double top and double bottom. We have, you can either call it equal highs and equal low. You can call this M pattern equal high. You can call this W pattern equal low, or you can call it double top or double bottom. Depends. We have triple top and all. So this is what we mean by trend line liquidity. This is what I mean by trend line liquidity. It means that there are liquidity resting on this. Why is it so? People are selling from here. Those retail traders, there are people that trade just chart patterns. They are selling from here, that market reacted from here. So they immediately market touch the trend line, they want to keep selling. So these are all liquidity. So most of the time, what you will see is that market may do something like this. Take out all this liquidity and drop massively to the downside. The same thing will happen here. Market may decide to go all the way up, take out this equal highs, and then drop all the way down. The same thing, market may come all the way low to take out this equal low, and then goes all the way back up. Now, because of the so many things that is considered as liquidity in the market, we want to simplify this liquidity into two or three parts. So anytime you hear of liquidity, what we want to look into right now is what you should pay attention to. The likes of double top, double bottom, you know what it is, but they are not your concern much like that. The ones that are very much important to you is what I want to give out to you. Remember what I told you, that I will give you what you need. Do you understand? So what you will use to work, what you can use to trade. The information you need to trade well is what I will be showing you. So we'll be looking at the first kind of liquidity we want to look at. We want to look at transactional liquidity. Transactional liquidity. We want to look at structural liquidity. Want to look at structural liquidity. So in fact, these are the two types of liquidity we will be paying attention to. So everything is more like a building block to what I am saying. We started from candlestick, we go back to market structure. Now we are on liquidity. And before we came here, we have established the basis by understanding the advanced market theory. And also, we've talked about swing structures, where we are able to identify what a bullish swing structure looks like and what a bearish swing structure looks like. Now, what is transactional liquidity? What is it used for? Transactional liquidity is a type of liquidity that you will see when a market give a break of structure, or rather is a type of liquidity that is used for a corrective move in the market. To explain or to help you understand better, we give a schematic. So suppose you have a bullish swing structure like this. Now, anytime I say bullish swing structure, by now you should have an idea of what I am saying. So we have a bullish swing structure like this. Market take out a previous low and give us what? A breakout structure. Now, this is the previous low that I was talking about, and this is the breakout structure that happens. Now, this breakout structure, this first breakout structure you're seeing is what we consider to be called transactional liquidity. And why do I say so? Because it is used for correction, meaning anytime you see it happen, the next thing you want to expect from the market is the market should create what? A retracement. The transactional liquidity is used for retracement or correction. So anytime you see it happen, the next thing you want to say is that market should give you a retracement. Now, this retracement will create another type of liquidity, which we call this structural liquidity, which is this. Which is this. Now, this structural liquidity has produced another breakout structure. So what is this structural liquidity used for? This structural liquidity is used for continuation, meaning that anytime you are expecting a market to continue in a particular direction, there has to be some sort of structural liquidity that that market will take. Now, this is a bullish market. Does that mean that you can enter a buy from here? Does that mean that you can enter a buy from here or from here? Does that mean that if market retraces to this level here, you can enter a trade and expect it to go up, or you wait for market to come here, enter a trade and expect it to go up, or any level here and expect it to go up? The answer is no, you don't want to do that. That is a very huge mistake you'll be making. And that is the reason why you are learning about this liquidity, because we just explained to you that structural liquidity, which is this line, is what we use for what? Continuation. That before this market will continue going up in the upward direction, this liquidity needs to be taken. So what do you want to do? You want to be patient enough for price to clear out this line before you are expecting any move. Now, for those of you, I'm sure you guys are familiar with the setup I normally dropped for you guys in the group. Most of the time, you'll be able to identify a line like this. You always see me draw a line like this. Now, this line that I am drawing is representing my structural liquidity. And if you notice, most times my POI is always below that line. It's always below that line. So that is why you hear me tell you price must get to the POI. Before price will get to the POI, it means that this structural liquidity has been taken. So the confidence in most of the trade we are taking, which has been going well for a couple of days, or throughout this week, is on the fact that market will take out structural liquidity. What is this structural liquidity used for? It is used for continuation. So if I am in a bullish market and I am able to see that structural liquidity has been taken, I'm expecting that price should go up. So I waited for candle to for the market to tap into my POI, thereby creating some sort of confirmation candle for me before entry. So I believe you guys understood what I have said so far. I believe you guys understood what I have said so far. So this is basically what you want to look out for. These are the two types of liquidity that is of importance to you. So this is for a buy scenario. Now let's look at a sell market condition for you to understand what I am saying better as well. So first, if you want to see a bearish market in the advanced market scenario, which is what is our concern, I want to see that a previous high needs to be taken out, right? Market needs to give me a break or structure. So we have a sweep of this high and this break of structure we have here. Now this first break of structure, this number one break of structure we have here is what we consider to be what? Transactional liquidity. Now we expect a retracement, right? We expect a retracement, and this retracement, because we said transactional liquidity is used for retracement or correction. So anytime you see it happen, we expect the market to create this retracement. And this retracement should create another kind of liquidity, which we will call what? Structural liquidity. So this line here, this edge that I'm extending out is what we refer to as structural liquidity. Now, structural liquidity is used for what? Continuation. It means that if this market starts retracing, I am not expected to take any sell position. I'm not expected to make any move here. I'm not expected to do anything with this market until price take out this liquidity, this structural liquidity. It is when price take it out that you can now start looking out for continuation, because what? Structural liquidity is used for continuation. So this is where we'll be stopping today. Okay, before we stop, let me just show you some few examples on the chart. Let me show you some few examples on the chart. And the assignment that you will have to do for me is, once I finish showing you what you need to see, the next thing is you on your own have to go back to your chart, open your chart and look at it. Your idea is not, you're not concerned about doing a perfect analysis right now. Your concern is you should be able to point out those things that I have marked out. So let's look at some pairs. Let's look at this volatility 25 index. So this is what we are saying. This is what I'm saying rather. You see that this is a chart of volatility 25 index. So look at what happened here. This was a previous low that market took out, right? Then price gave us a break of structure. And this is the first break of structure we have. Now, what is this break of structure? What is it for? It is called transactional liquidity. Why do we say it is transactional liquidity? Anytime it happens in the market, we expect the market to create what? A retracement or a corrective move. And what do you say? You say that when this thing was taken out, what happened? The retracement occurred. Now, this retracement is to create another type of liquidity, which we consider to be what? Structural liquidity. And that structural liquidity gave us what? Another break of structure. So I'm saying that you're not expected to make any trade entry. Now look at what happened. Remember we talked about candlestick anatomy. Now after this structural liquidity has been identified, you see that market created this hammer candle. When we are treating candlestick anatomy, one thing I told us is that you should never trade candlestick in isolation. Don't just go to your chart and see a candle and you say, oh, I just learned about this candle, market is about to go up, and you start trading. No, because if you have entered from here, which a lot of person did, you think you have market moved a bit in your favor and think you're in profit. What happened? You'll be taken out. The reason is because you have a structural liquidity that has not yet been taken out. And then your POI is always around here. So what happened? What happened? You see that the market eventually comes to this box. This is your POI. This is your POI. Now, if you are entering from here, you notice that when the market take out this structural liquidity, there was a reaction, but price needs to tap into your POI properly. That is why in the VIP group, I am always insisting on wait for price to tap into your POI, wait for price to tap into your POI. And what happened? After market take out the structural liquidity, price tapped into the POI and give a candle confirmation. What are these candle confirmation? Look at this. We have this rejection followed by a bullish candle. So these are confirmations that the market has created. So this is when you are allowed to enter this market. So that is one. Another thing again I want to show you here, you will notice is this. This is the market taking out what? A previous high. Now in our next class, we are going to look at the full setup, because what I've just shown you is more like what you'll be trading. What I've just shown you is what you'll be trading. Market take out this previous high, right? Then created a structural liquidity here. We have our break of structure. What happened? Even though we see that market came here, it did as if it want to come down, came up again, did as if it want to come down, it still have to go back up to take out what? This structural liquidity. It has to take it out. And immediately price took out the structural liquidity. What did you see? You see that the market dropped massively to this level to come and take out another structural liquidity and goes up aggressively again. So let me look at where this is a sell scenario, this is a buy scenario. Let me look at where this thing happened again. You will always see it in many places on the chart. You always see it in many places on the chart. Now look at this area as well. Look at this area as well. This is a previous high. Market took it out. Sorry. Market took out this high. Market took out this high, right? We have a break of structure here. Before then, which could be our transactional liquidity, price then have this area which will be our structural liquidity. And what happened? Price eventually came up to take out this structural liquidity and reacts to this level here. Now when we get to POI, you will understand, which will be our next topic. React to this and sold massively. You see how the sell is, very, very massive. So it is very, very important. So let's look at where we can spot such scenario again. Let's look at where we can spot such scenario again. I don't want to make this class too lengthy so that you guys will have time to eat. But then I believe you guys understood everything I've said so far. So if you have any question, you can ask your question, or mute your mic and ask your question.